Can the IRS penalize you as a tax return preparer? The short answer is yes. Let me explain. There are several penalties the IRS could potentially assess against a tax return preparer. However, we will focus on IRS due diligence penalties. What is a due diligence audit? The IRS requires compliance with due diligence for certain tax benefits, such as earned income credit or child tax credit, that are a part of the IRS Preparer Compliance Program. The purpose of this program is to review returns prepared by tax preparers with a high chance of errors or potential fraud. Currently, the penalty for not meeting due diligence requirements is $560 for each credit. What does the audit process look like? There are 4 steps: selection, notification, review, and determination. We will explain this process. 1. Selection. A tax return preparer may be selected for an examination if their client's returns are selected for audit due to errors on the returns. Normally, there has to be several returns selected for examination that were filed with high error rates to potentially put the IRS on notice for a potential due diligence audit. 2. Notification. The IRS will send a letter 6199 requesting a due diligence visit, either face-to-face or through correspondence. 3. Review. The IRS will normally ask for 25 client returns, but could potentially ask for more. Also, the IRS agent will interview the preparer about business practices and procedures when preparing a return. During the interview, the IRS agent will be looking for compliance with the 4 due diligence requirements. Keep that in mind if you are facing a due diligence audit in the future. 4. Determination. The IRS will determine if you met all due diligence requirements by reviewing the returns and the interview answers. The IRS determination is not final. The tax preparer has appeal rights. There are 4 due diligence requirements that the IRS requires tax return preparers to meet. 1. Complete and submit Form 8867 due diligence checklist. 2. Compute the credits. You want to complete the correct worksheets for the credits. 3. Knowledge requirement. And 4. Record retention. As a preparer, you are required to keep copies of all documents that were used to compute and determine if a taxpayer qualifies for a credit for 3 years from the due date of the return or date the return was filed, whichever is later. The knowledge requirement we see the most proposed penalties for. What is the knowledge requirement? To simplify, 1. Tax preparers must know the law. 2. Ask the right questions, especially when the information given by a taxpayer appears incorrect, inconsistent, or incomplete. 3. Document the questions asked. And 4, get all the facts to determine if a taxpayer qualifies for a credit. Based on our experiences, tax preparers tend to not meet the knowledge requirements because they fail to document the questions asked to determine if their client qualifies for the credit. In conclusion, what are some tips to avoid due diligence penalties? Maintain records. Stay up to date on the law. Review the due diligence checklist to make sure you cover all your bases. Keep records of your decision-making process. Create your own checklist to make sure you covered all due diligence requirements.